Welcome to the Phuble podcast, a podcast where we talk about all financial markets around the world. I'm Phil Monvianis, and this podcast is sponsored by Phuble, the social networking platform for any and all investors. It is Saturday, February 1st, so we're going to be discussing the previous week in the U.S. stock market. The Dow Jones finished the week down. Actually, Friday went down about 600 points to 28,256. NASDAQ was down as well, about 150 points down to 9,150. And the S&P was down 58 points to 3,225. All major U.S. indices had a relatively downward week. That was mostly due to the coronavirus, which has spread outside of China. The current death toll for the Wuhan coronavirus is about 300 people. Confirmed cases rose to 11,791. American Airlines and Delta suspended all flights to China. Those were the major U.S. airlines to completely forego flights, at least in the short term, to China altogether. The Trump administration issued a mandatory quarantine for U.S. citizens who visited the Hubei province, which is the province where Wuhan, the city of Wuhan, is located. They issued a quarantine for U.S. citizens who visited that province within the last 14 days. The Trump administration also denied entry to foreign nationals who they say pose a risk of transmitting the virus. That was the main reason why the Dow, NASDAQ, and S&P and all major U.S. indices were down. Dow still above 28,000, NASDAQ still above 9,000, S&P still well above 3,000. They're doing still very well for January. The coronavirus effect on the stock market is going to blow over relatively soon. I think all major U.S. indices are going to go back up in the short term. Also, another event that potentially affected the stock market was Brexit. Britain left the EU officially on Friday. Actually, the pound rose against the dollar, and the pound has been rising against the dollar ever since the middle of last year. I think it was more due to the certainty of what is going to happen with Britain leaving the EU. They finally cleared up that they would leave for sure. This is just the beginning of Brexit. There's nothing that's really been solved. They still have about an 11th month period where they need to negotiate trade deals with the EU. Long term, Britain is going to suffer economically from this because they're not going to have the strength of other countries. Also, the complications with freedom of movement with their own people and people who are going to work in the UK. In most situations, a group is always stronger than an individual, and that goes with countries as well. A group of countries is always going to be stronger than just one country. It's going to be complicated for them. I expect the pound to kind of decrease a little bit over time, probably not in the short term. Probably in the short term, this was a win for the pound. It'll probably increase to about $1.35, $1.36 against the US dollar. But I think long term is going to decrease again below $1.30, which is kind of what it was trading at back in 2017. Just going over the commodities real fast. WTI is at around $51. Brent is around $56. Oil, once again, floating between that $55 to $65 range. Nothing in the market to signal that it's going to change drastically again. COMEX is around 1,587. The XAU spot index is around 1,589. Gold shot up almost to 1,600 this week. Gold had a fantastic week. Gold's going to increase substantially over the next year, I anticipate. I do think gold is still a great investment. It's probably going to break through 1,600 in the next couple weeks. Switching to U.S. Treasuries, the 2-year bond yield is at 1.31%, and the 10-year is at 1.51%. There is no inversion between the 2-year and the 10-year bonds, but they are closing. The gap is closing. There were a lot of earnings this past week, a lot of Q4 2019 earnings. Just going to hit two big releases that I thought were significant. Amazon released their Q4 2019 earnings. Earnings per share was $6.47 versus $4.03, which was expected. Revenue came in at around $87.44 billion versus $86.02 billion, which was expected. AWS revenue was $9.95 billion versus $9.81 billion, which was expected. They absolutely blew out earnings. AWS is where they make their profit, and they crushed it. They were almost at $10 billion for AWS revenue for quarter 4. Revenue grew 21%. There are 150 million people signed up on Prime as of December 2019, according to Jeff Bezos. Net income grew 8% year over year to $3.27 billion US. Amazon worldwide shopping costs increased to $12.9 billion. I believe that was just in the quarter 4. Another significant category that they're adding to is their advertising business, which is comprised in their other category, that generated $4.8 billion US. That is up 41% year over year. I am all in for Amazon right now. Their stock went over $1 trillion. I know there are a lot of people saying that they are overvalued. The pop was just because they blew out earnings. People were saying that the stock is going to probably pull back, which is possible, but they deserve the $1 trillion company price tag, which they have. Their stock is a little over $2,000 per share. They're going to be a $2 trillion company. I have all the faith in the world that will happen. They're going to get their shipping costs down for sure. Once they have a majority of their fleet established across the world, which they're doing, that they're investing heavily in their shipping fleet, which was so smart on their part, and just avoiding FedEx and UPS. I was unsure about it back when they actually started investing in their own fleet, but now it was definitely a great decision. They're going to experience economies of scale. They're going to get those costs down. They're going to be able to provide one-day shipping faster than anybody else. I'm telling you, they are going to master this thing. They're going to be able to turn a profit on this just by having people sign up on Prime. They are going to be incredibly successful, and it's all because of their investment in their own shipping. Also, AWS, fantastic service. We use them to run the Phuble platform. I might be a little bit biased, but they are going to grow. They're going to outgrow Microsoft. Right now, they're not actually turning a high profit because of the high cost to get products from sellers to customers. Once they get their whole distribution process and supply chain process established, they are going to have economies of scale, and they will turn a massive profit in the future. Their advertising business is so small right now. They're going to be able to expand that. They're going to get into markets faster than anybody else. They are truly going to be an international brand. Another company that released earnings was Chevron. They are not a good company to invest in. I would short them. I would short Chevron forever. I don't think they'll ever bounce back to record highs for their stock. Their earnings per share came in at $1.49 versus $1.45, which was expected. So they did beat on EPS. Revenue came in at $36.35 billion versus $38.64 billion, which was expected. This was all for quarter 4 of 2019. They posted a $6.6 billion loss due to $10.4 billion worth of write-offs. Their total earnings in 2019 slid 80% to $2.924 billion. In 2018, their total earnings were $14.82 billion. The average price per barrel of oil and natural gas was $47. That was down 16% compared to 2019. A few things are going to plague Chevron and all the other major oil companies like Exxon. One, the price of oil is not exploding anytime soon. People are moving away from fossil fuels and into renewable energies. That is just the trend. That trend is only going to expand in the future. Nothing is going to push oil above $65 unless there is a massive catastrophe somewhere in the world that just destroys production for a long period of time, oil production for a long period of time. The second issue, investors and younger investors that do not want to invest in malicious companies, environmentally harmful companies, like the fossil fuel companies, for example, Chevron, Exxon, MRO, which is Marathon Oil, all the major companies that produce oil that are listed on stock exchanges are now becoming the new tobacco companies. So even if they seem like they are cheap and a viable option for investment, people will not go into them because they overall produce a harmful effect on society and the environment. Those are two main reasons, and those reasons will absolutely crush a stock. So I would short Chevron. The last stock that I'm going to mention that I'm pretty indifferent about is Citigroup. Citigroup is offering a free Robo advisor program for customers with at least $50,000 at the bank. Users answer a few questions about risk appetite and investing timelines, and a software places them into a pre-made portfolio. This isn't new. A lot of banks do this now, and a lot of brokerages do this now. Those who don't qualify are charged a 0.55% fee of assets under management. Basically, you have to have $50,000 at the bank for this program, and they only give you one free portfolio. Most other banks charge a 0.35% to 0.45% fee of assets under management. JP Morgan Chase, Bank of America, Wells Fargo, Morgan Stanley all had robo advisory programs. Citigroup is extraordinarily late to offer this service. I mean, they're not a good option to go to if you want to trade online. Charles Schwab already abolished stock trading commissions completely. TD Ameritrade, which is going to be acquired by Charles Schwab, also cut commissions to zero. If you don't have a linked checking account at Citi, they charge you $12.95 to trade an ETF, and they charge you $12.95 to trade stocks. If you do have a checking account with them, both of those drop to $6.95, which is still absurd. Citigroup is like your friend's dad. He wants to stay up with all the new trends, but he's about a year and a half late. They're a traditional bank. They're the most international bank, I believe, of all major U.S. banks, but they are so late with a lot of their plans for the future. They could go either way. I mean, they're not going to probably increase more than 7-8% in the upcoming year, but they're not going to decrease probably more than 10% either. They're like a slow growth stock. Right now, you can't really go wrong with any banks. You can get a lot of banks cheap even now with low interest rates. Once those interest rates start increasing, then banks are going to earn a lot more in the future. All right, that is all for the Phuble podcast. Thank you so much for watching, and happy investing.